Here's a statistic that should shake you. 80% of professional fund managers fail to beat the stock market average over 10 years. That's right. People whose job is to pick winning stocks can't even do it reliably. Meanwhile, ordinary people with regular jobs are becoming millionaires by doing almost nothing. The difference? They're using index funds. And in the next 6 minutes, I'm going to show you exactly why this strategy works and how you can start today with just one investment decision. Let's start with the basics, because if you're hearing the term index fund for the first time, it can feel intimidating. An index fund is simply a collection of stocks bundled together to track a specific market index. Think of it like this. Instead of buying one house on one street, you're buying a piece of every house on every street in your city. When the city grows, all your properties grow together. The most famous index is the S&P 500, which is literally 500 of the largest American companies. When you buy an S&P 500 index fund, you own a tiny piece of Apple, Microsoft, Amazon, Tesla, all of them. And you do it with one purchase. So why does this passive approach beat 85% of active traders? Simple. It removes emotion and cuts costs dramatically. When you pick individual stocks, you're paying higher fees, you're trading constantly, and you're making decisions based on fear and greed. Index funds charge maybe 0.05% annually. That's literally £50 per million pounds invested. Active funds charge 10 times that, which compounds over decades into hundreds of thousands in lost returns. Plus, index funds let you stay invested through market crashes instead of panic selling at the bottom, which is when most investors destroy their wealth. Now, how do you actually choose your first index fund? There are only 3 things you need to check. First, is it tracking a major index like the S&P 500, FTSE 100, or a global all-cap index? Second, what's the fee ratio? Aim for anything under 0.2%, ideally under 0.1%. Third, can you buy it through your existing bank or investment app? That's honestly it. You don't need to understand what a derivative is or what yield curve inversion means. Open your brokerage app, search for VTSAX or VOO or your local equivalent, set up a monthly contribution, and you're done. Your future self will thank you. Let me give you real numbers, because this is where it gets exciting. If you invested £5,000 today in a global index fund, and the market grows at its historical average of 10% annually, which is what's happened over the last 80 years, in 30 years, that £5,000 becomes £87,000, without doing anything. No trading, no stock picking, no stress. Now imagine you contribute £200 monthly for those 30 years instead. You're looking at £850,000. That's not a get-rich-quick scheme. It's better. It's a get-rich-slowly scheme that actually works because it leverages time and compound interest. But here's the critical thing most beginners miss. The best time to start was yesterday. The second best time is today. Every year you wait costs you tens of thousands in lost compounding. If you're thinking about starting next year when I've saved more money, you're already behind. Start now with whatever you have. Even £50 monthly compounds into serious wealth. The only real mistake is never starting at all. If you're serious about building wealth and tired of feeling confused by finance jargon, this strategy is your foundation. Like this video if it helped. Subscribe for more personal finance content that cuts through the noise, and let me know in the comments. What's stopping you from investing right now? Because honestly, the answer might be easier to fix than you think.